Hello, welcome to Mini Masterclass Thursday. I am joining you just a few minutes late. I had a call that just got over, so apologies, but we're here. So we're going to get to it. It is that time of year again. It is tax season, and I genuinely feel like there's really never not a tax season anymore because between extensions and regulars and people extensions on the regular for natural disasters and all kinds of things, and we're always in some sort of tax season. But we're going to talk about tax time readiness because every single year for the last 10 years I've had the same experience, and I'm in at least a 2 dozen at this point, counting threads in every possible platform you can imagine. And I'm not alone in my experience. And every year this time, people, business owners in particular, they're either freaking out because they haven't done their books, they haven't kept things updated, or they are getting started on like trying to make sure 25 is in order, and they want to make sure they've got everything done that they need to have done to make sure 25 is okay. Maybe both. Maybe they're freaking out about the past, but also wanting to get on top of the current. And also tax preparers, you guys, I made a story about this recently if you follow our Instagram, but since 2020, there have been 340,000 CPAs and tax professionals that have left the industry. They have retired, they just plain old quit, they switched careers. A lot of them, unfortunately, did also pass away, and they're not being re, um, how do you say it? They're not, new people aren't joining. There's also a 17 and a half, no, 30% reduction in accounting student enrollments across the country, simultaneous to that many leaving. So, long story short on that, there is a giant shortage of tax professionals versus business owners. And what we're seeing across the board is that um, people aren't able to get a hold of a tax professional, or it's taking much longer, or so many people have to go on extensions because their tax preparer can't handle the volume, or tax preparers are now getting very particular about who they will work with, how they will work with you. They're no longer scrambling to like just take anybody because they want the business. They're like, sorry, I'm not going to work with you because XYZ. Sorry, we don't do that. They're turning people away left and right because they have plenty of business. So from a business owner's perspective, yes, it sucks because it makes it harder on you. But if you do some simple things to put yourself in a position to be ready for tax time, and you're engaging your tax professional and accounting partners all year long, even if they're not doing your books for you, but they're helping you with tax planning. You're asking them questions, you're doing reviews with them, you're making sure you're being diligent about compliance and all of those things. Tax season is going to be so much more beautiful for you, for them, and you're going to have a much easier experience. And there are certain new rules and regulations where the government is now basically punishing, for lack of a better term, punishing tax preparers for not filing taxes correctly. And you might think that, oh, that should have always been the case. With CPAs, it always is the case. CPAs are held to a little bit higher standard, and they are supposed to do their due diligence and understand the return inside out, upside down, and backwards, where the information came from, all of those things, and confirm its accuracy before they put their stamp on it. But if you can be a tax preparer and not be a CPA, and in that case, you don't have those, you're not held to that same standard. So anybody can file to be a tax preparer registered with the IRS. I don't know if you all know that, but you don't even have to be an accountant or having gone to accounting school. There are quite a few tax preparers out there that kind of just do it as a side gig or do it for their family or something. And they just got their P10, personal identification number, to file with the IRS and do taxes. So, and anybody can go on TurboTax and file their own tax return. Anybody can go into H&R Block and file a tax return. So the point is, you can do a lot of things though to put yourself ahead of like a lot of the problems that are facing business owners during tax season. First and foremost, I pretty much know I'm going to say this: keeping your records up, keeping your books up, doing it every month. Depending on the size of your business, it might feel like, oh my gosh, my business is very small. I don't need to do this all the time. I guarantee you, if you're in your numbers, you are just going to have so much more luck. You're going to have better luck scaling. You're going to understand your business more. You're going to make better business decisions faster than waiting until something happens that triggers you to have to make a change. You're going to be able to be proactive instead of reactive. You're going to be able to put tax planning strategies into play ahead of time, and instead of having to hear, oh, well, if we had known, we could have done XYZ, but now it's too late. There's so many reasons you want to know your numbers, even as a very small business. I just can't say that enough. Even if you're the one doing the work, I highly suggest you're meeting with someone at minimum quarterly, keeping in touch, like I said, with an accounting professional so that by the time you get to taxes, you're not one of those people calling around trying to find somebody taking on new clients, because you just may not find it, or you may not find someone that really is the best fit for your business. Tax preparation, it seems very clerical. You just put numbers into a machine, you spit out the tax return, and you could probably owe money if you're a business owner, or maybe you don't. But that's not really what it's supposed to be. It's supposed to be a full overview of your business, of your numbers, of the tax strategies available to you, of how to pay yourself, what to pay yourself, of how to scale, of this, of that. It's not supposed to be transactional. It's supposed to be transformative in one way or another. And that's what I wish there was more education around. It is one of the reasons I did create our financial literacy workshop that we do all over the country, but it just nobody talks about it. It's not just a return, it's so many other things. And there's a lot that goes on in a tax return that does not happen in your bookkeeping. You have no line of sight on it from the bookkeeping, but because of the bookkeeping, a tax preparer can identify opportunities that you can have throughout the year in your business. And moving forward, you can do future tax planning, you can do budgeting, you can do other things like that that will affect future years, not just the current year that you're in. So I want to go through, we do, by the way, have a resource, a tax season survival kit resource. If you just let us know, you can DM us here. You can comment if you're seeing this posted somewhere. Just reach out on our LinkedIn page or our Instagram page, and we'll definitely give you this resource. But it's a tax season survival guide. It kind of gives you all the different things you might need to be tax ready. The IRS has opened for e-file, so you're officially able to file your taxes as of today, February 13th. Doesn't mean you're ready to, but you can. So some people are ready, which is wonderful. But the actual deadlines coming up are March 15th. No, I lied, 17th this year for corporate returns, and April 15th or 17th. I don't know. If the 15th falls on a weekend, it's the 17th for personal. So, and personal could be, even if you're a business, but you're Schedule C, which means you're individual and you don't have an LLC or an S Corp election, that's also part of your personal. Did you have a question? No. Okay, we're good. Okay, so those are the deadlines coming up. By now, you should know if you're ready to file your tax return. You should have everything you need to file your corporate tax return. If you don't, I'm going to say you probably are going to need an extension. Depending on who your preparer is, they may at this point in time say, sorry, I needed everything by a minimum of 30 days before the deadline to get to everything. Now, you may have better luck than that. You may be somewhere with a little less volume and they can fit you in, but I wouldn't count on it. And if you know, okay, I just need to do a little more digging, I need some more cleanup, just tell them I need an extension. Just file the extension because they will love you. It will get you off their plate, out of their queue for having to meet that deadline. And it gives you then the ability to work on getting yourself up to date without that pressure looming over you of having a deadline approaching. Here are some of the very absolute non-negotiable things you need to make sure are done in your business books in order for you to know you are tax ready. First of all, you may not be doing this work. Someone else might be doing this work for you, but you should be going through it with them and understanding that it's accurate and completed. So duplicate vendors, I see this so much, and we just got through a 1099 deadline, and this might have been a challenge for you, or it might be one for you in the future. A lot of times in our bookkeeping, you will see a duplicate vendor. So the vendor might look like ABC Company and ABC Co. and ABC Co. dot, like a period, and maybe A.B.C. company, all the same vendor, but depending on who put the information in, if it was coming from a third-party app, if there was a receipt capture situation that had it spelt differently than the original version and nobody caught it. There's so many ifs, ands, or buts about why vendors are duplicated. That is a huge problem because some 1099s, if that vendor was supposed to have been issued one, for the total amount that you paid them, it's not going to register as one big vendor. It's going to register as four little vendors, which means they might be independently under the threshold, but collectively you missed a 1099 that you were supposed to issue. 1099s are the way that you guarantee that that expense is a write-off for your business. If you do not 1099 a vendor appropriately and you're audited, there's a couple things that happen. We have a whole mini masterclass on 1099s, but there's a couple things that happen. One is you can get fined for not having 1099s appropriately. The other is they can disallow that expense as an expense, which means it becomes taxable income back to you, which means it adds back to your taxable liability on that year, which could create more tax for you, which has penalties and interest added. And you're then out of compliance from the corporate side of things as well, and there's penalties and fines for that. So just making sure you have no duplicate vendors will actually help you find so many mistakes, I promise you. And it will be, you'll be in compliance for 1099s. And when you go to file your taxes, you won't be potentially duplicating your expenses. Now, if you're reconciling your books every month, you would have already caught all these duplications, but we again know how real life goes, and sometimes books are turned over that aren't completely reconciled, which in theory means you're not ready to file. You cannot file, you should not file unless every account on your balance sheet has been reconciled, because you don't know then if they're completely accurate. If there's duplications or omissions, either way, you have some inaccuracies in your books. And by reconciling, that's the only way you're going to find that. We have a whole mini masterclass on that, as well as an advanced workshop replay that we can send you information on, all about reconciling your balance sheet, your whole balance sheet. Uncategorized expenses. This is huge. A lot of people don't know what exactly to call something, so they'll just throw it in uncategorized, or maybe an account like Ask My Accountant or Ask Bob. You know, Bob's the owner and Bob does weird things with his debit card. Nobody knows what he's doing, so they throw it in Ask Bob. Some people put miscellaneous, some people put other expenses. None of that can go on a tax return. Tax return is very specifically around what is a business expense and what is the business income. So If you have something uncategorized and at the end of the day, you cannot figure out what it actually is, the only appropriate action to take is to turn that expense from uncategorized into a distribution or a draw from your business because it was still money that was spent out of the business account, which was earned by the business income. But because it can't be explained as an actual expense, it is just money that came out of the business account, which is a draw or a distribution. There should be no miscellaneous, no other, no ask my accountant, no nothing that is not categorized as a business expense legitimately left in your financials. It has to be moved over to distributions or draws if there is, which is just more taxable liability for you on your K1 or at the end of the day if you don't get a K1. Outstanding accounts receivable and accounts payable. Accounts receivable is your invoicing and your who owes you money. At the end of the year, you should run that report, accounts receivable aging summary. And I'm talking QuickBooks Online, always in my language around accounting software. So if you have a different software, there's going to be a very similar report available, just maybe not called the exact same thing. But you're going to want to run that report and make sure that every single outstanding invoice that you show open is in fact open. This is where a lot of people start going, wait a minute, I know he paid. I know she paid, but their invoice is still showing open. Right there, that tells you right there, you have duplicated or overstated income in your financials. Because if you have an open invoice, that's income. That's an income generating form. If you've also, somebody has also categorized the deposit that was supposed to be connected to that invoice and hasn't connected it, it's also counting as income. So now you have two sets of income in your financials that really is not accurate. It's overstated, which means you're just taxing yourself more than you need to tax yourself. And nobody wants to do that. We did have somebody come up to us once and she was like, I know my books are wrong, but I have no idea why. And it was to the tune of over $1 million. They had overstated their sales and they did not have the expenses to support that inflation of sales. So they were going to get this tax bill that was crazy, but we were able to go ahead and all of it had to do with somebody didn't know the process of after you collect the payment, you have to attach it to the invoice. So it was all duplicated in their books. So making sure you run that report and run the report called accounts payable aging summary. This is going to show you everybody you still owe money to at the end of the year. Now, this is only going to happen if you put the information in QuickBooks. Not everybody uses the accounts payable feature. I highly recommend that you do because it will complete your financials. It will show your total liabilities accurately. You'll also be able to use the system to pay the bills themselves and to keep track of what you owe and when instead of having pieces of paper lying all over your office. But this is going to be a way that you might also be able to recognize duplicated expenses, which are also bad because they lower your taxable liability, which means you're paying less taxes than you're supposed to. Also a bad thing. And it skews your profit margins. It skews your historical data because you really didn't have this expense that's in there twice. I just helped a customer earlier this week who we went through his payables, and by golly, there were probably 3 to 10 invoices that or bills that had been duplicated because they got entered twice. And nobody realized that, and they were sitting there, and it was like tens of thousands of dollars of overstated expenses. So running that report, making sure it's accurate, and all the bills that you show as owed actually are owed as of December 31st. Receipts. And there's this big, we have a receipt mini masterclass too, just so you know. But there's this big thing. Do I really need to keep my receipts? Yes, you really do. If you're audited, the source document is what is going to get you out of or get you through the audit. A statement is not going to do that. The source document is going to do that. They are going to ask for the proof of whatever they're questioning. It could be one transaction, it could be an entire that whole year's worth of those transactions. I tell you, I can give you some hints, just travel and entertainment and anything that is considered meals. Write explicit notes on every single thing you can. Who you were with, what you were discussing, what the business event was. Um, all of that will matter in an audit. I've seen now 2 audits where travel specifically has been disallowed as expenses, even though it made legitimate, perfect sense that this business would be traveling for normal and ordinary transactions within their business, but there were no notes and there was no proof that this particular event was business related somehow. No proof. Receipts, yes, but no proof. So please do yourself a favor and write on anything entertainment or travel related, especially because if you're buying supplies or products or services, it's very clear on the receipt what it is and why you would be buying it. But travel isn't. You could be going just on family vacation, or you could just be taking your spouse out to dinner. You need to be explicit in order to make sure that you're audit compliant and that you won't have any trouble in an audit. You're always looking, record keeping isn't just about knowing your numbers. You're also making sure that in an audit, you have everything you need. I'm in 2 audits right now with customers, and I can tell you that every single thing that I'm talking about now and that you've probably ever heard from any accounting professional has been found in those audits. They're not going well. They're going to owe a lot of money because they decided they didn't need to follow anyone else's rules or look into what was compliance or follow any kind of advice. They are now going to be paying a lot of money, which might be devastating to their business at the end of the day, to all of our businesses. So you're always looking how will this affect me in an audit? Is this decision a good one for my business? Is it audit compliant? Do it or then don't do it. Uncleared payroll checks. So this is a problem I see a whole lot. Payroll is one of those things that because it is reported on your behalf, you have to correct it. There is no just like, oh, just delete that check. It never cleared. Oh, I accidentally paid him twice, but he only cashed one check because those payroll dollar amounts are already reported and taxes have been paid on those amounts. So uncleared payroll checks actually need to become a payroll correction that is done by whatever payroll company you're using in order to have accurate numbers. So most often I just ran payroll wrong. So I run it again and then I only gave them the one check. But the payroll company has actually reported both checks because you ran it wrong, just in theory. So you need to get that corrected because that will be an outstanding item that never got reconciled. Taxes were paid on it, and the payroll correction will correct the amount that they actually received on their W-2, as well as the taxes they paid and that you paid as their employer. So all of that has to be refunded to you and potentially to them. It's a whole thing. So don't let uncleared payroll items just go and go and go because really they need to be a payroll correction. This just may extend the time that your employee can file their taxes because they're going to have to wait for their corrected W-2 if you haven't really kept up with this all year long and caught it before the end of the year. That you're going to have to tell them your W-2 will be delayed. You can't file until your real one comes in or your corrected one comes in. So just a heads up on that. No uncleared payroll transactions. The reconciliation of every single balance sheet account should be done, and there should be no unreconciled transactions as of December 31st, with the exception of anything that was actually legitimately outstanding, meaning it got paid in January, so it was still outstanding in December. That could be payroll liabilities, that could be checks that are uncleared, that could be credit card purchases that you ran in December, but they cleared or posted in January. So there are some exceptions, but other than those, you really should have every single account balanced and reconciled on December 31st. or as of December 31st before you do your taxes, because that means you've caught anything that's extra, duplicated, omitted. Your balances for the balance sheet are correct for your assets and your liabilities, which if you're an S Corp or a C Corp, that's a big deal on your tax return. Go through your owner's draws and your distributions, see what's in there and verify that everything in there is legitimately a personal expense, not a business expense. I can't tell you how many times I have found legitimate business expenses sitting in owner's draw because somebody just didn't realize what it was or what to categorize it as. If you're doing ATM withdrawals, if you're doing petty cash type scenarios, if you're paying people in cash, all that needs to be accurately recorded. It can't just be, oh, supplies on a $400 ATM withdrawal. You really should have the receipts or receipts against that $400 in cash where you went and bought those supplies, all connected to the $400 withdrawal. So it's very explicit of what you use that $400 for. Otherwise, yes, it does become an owner's draw or distribution, and it's just money you took out of your business. Your reasonable compensation. We have talked about this a lot in the last several months. You have to meet reasonable compensation if you're an S Corp. You have to meet reasonable compensation if you're a C Corp. And if you're a C Corp, you cannot pay yourself more than reasonable compensation. Tax preparers are actually getting penalized and fined for filing tax returns now that don't meet reasonable compensation. There's an exception to every rule. So the exception to this is you don't have to have reasonable compensation as long as you have also not taken any distributions whatsoever from your business. So if you have taken distributions, you cannot technically do that. Those should have been turned into payroll by December 31st. And if you didn't do that, you would want to do a payroll correction, like we were just talking about, as the officer to turn said distributions into payroll so that you're not out of compliance, because that's going to be a big ding on you from your corporate compliance standpoint, as well as your tax preparer. You may not then find a tax preparer now who is willing to do a tax return for you if you haven't met this criteria, because their butt is on the line as far as getting a ding and fine for doing it. This is very specifically related to the fact that tax preparers were just taking anything and everything and filing a tax return and not paying any attention to these compliance type scenarios. If you're an S Corp, reasonable compensation has to be met, and then you can take distributions. Or don't meet reasonable, that's okay, but do not take a distribution. If you're a C Corp, reasonable compensation has to be met, and you cannot pay yourself any more than that, but you can also take distributions. So just making sure you're in line there. If this is Greek to you and you have no idea what I'm talking about, reach out. We can actually do your reasonable compensation analysis for you for 2025. Obviously, 24 is done. Unless you want to go down the route of a payroll correction, if you think, oh crap, I'm in big trouble here, you can still do that. And then you'll know in 25 what you can pay, what you have to and can pay yourself, or you just can't take any draws if you're not going to pay yourself that amount. Your W-3, which is the form that is filed from the payroll company that you use, whether it's Gusto, QuickBooks, Paychecks, ADP, whatever, they will all have a form. And that form has to match whatever wages are showing up on your P&L. So if those two things don't align, you probably have issues in your accounting that you need to fix before you're actually tax ready. Finally, all of your employee benefits, like your 401k, health insurance, we want to make sure all those totals are correct. If you're an employer that provides 100% of that to your employees for benefits, that's all an expense on the P&L. If you're an employer that does matches or contributions, part of it's from the employee and part of it's from the employer. So those splits need to be right. I see this all the time where things just aren't correctly categorized and it throws off your financials. I highly suggest you go through things like Amazon or Walmart or Target or places that could literally be everything and anything, and make sure they're legitimate business expenses. The only way you're going to know that is if you have the receipt. And there are lots of ways where you can do receipt capture throughout the year, make it very simple on yourself, your bookkeeper, your accountant, your tax preparer by having all the documentation you need to prove its legitimacy as a business expense. But also, if you're using QuickBooks Online, there is a direct connect to an Amazon business link where if you're separating, which you should, business and personal Amazon business is free. It doesn't have the same perks as Prime, but it is free. You sign up for Amazon Business, do only your business transactions through there. You can connect it to your QuickBooks. QuickBooks actually brings in the exact detail of every line item that you purchased. So you can categorize all the different things to all the different places. You can then say, oh, this one's dog food. So that one's going to be an owner's draw because I added that to my cart before I checked out. Instead of it having it all hit office supplies or something generic, where that's not really right. And so does the IRS. And that's going to be first place they go is, oh, Amazon, 120,000. Let's look at that. So just be careful with things like categories that could literally be everything. Use those receipts, make sure you have proof, split things out. It is okay if you take money out of your business as long as you've categorized it correctly. So if you went to Walmart and you bought paper for the printer and coffee for the office, but you also bought dog food, in theory, you're supposed to say these two things were office supplies and this one thing was an owner's draw, because that's the right way to categorize that. Then if you're audited, it's like, great, you didn't try to write off your dog food, you're okay. If you are a S corp or officer of any client, you can't do those personal transactions unless you've met reasonable compensation, unless you're paying yourself the right amount of money and you've hit that max or minimum for the year. You can't just decide, oh, I'll just have a personal card over or personal transaction over here. That should go on your payroll. So those are the types of things you want to be looking at all year long, or having someone look at them on your behalf to make sure you're compliant. Your As a business, always remember the money that comes into your business account is not yours, it's your business's. And when you take money out of your business for a personal expense, you're either drawing from the business's money or you're doing a distribution from your business's money. That is how it works. You can't just take money without recording it properly. Even if you're a sole proprietor, technically you want to be doing like straight draws that are 500, let's just say $500. Do a $500 draw and then use that 500 to go buy something. But don't just use your business debit card all the time and call it draw, draw, draw if you can help it. There's a lot of education we can give you around that. If you're new and this is kind of like Greek to you, or you're like, oh, I didn't know I couldn't do that, definitely let us know. We're happy to help. So also, personal tax returns, that's coming next. That's April 15th. You want to have anything like your home interest, your medical information, your child care information. Did you get married? Did you get divorced? Did you have babies? Did you move? All that kind of information is going to be pertinent to a tax return. Did you start a new business? Did you close a business? Did you sell assets of any kind? That's something you also want to make sure you're communicating to whoever's doing your bookkeeping. And if you're doing the bookkeeping, make sure it's in your books, the sale and or a loan that you took out. All of that stuff needs to be added to the financials for the year. There's also some really cool things you can do if you talk to a tax preparer ahead of time. Like, for example, the Augusta rule is where you can use your home for business events, and actually your business can pay you tax-free for the use of your own home, which is a very cool tax strategy that you can utilize. But you have to have these conversations. You have to make sure it's on paper that it makes sense for your business. You don't want to just willy-nilly go doing some things and then at the end of the year learn, oh no, none of that is going to work. And then you've spent all this money, or you don't have the tax savings you thought you had, etc. So that's my few tips for us today for accounting for our businesses on making sure we're tax ready. If you do all the things we just talked about, if you're working with a tax planner or preparer or an accounting professional all year long in some capacity, whatever works best for you, you're going to have such a better experience at tax time. I promise you. You may not like the result of having to owe taxes, but at least you'll owe a lot less than if you didn't know any of this and you just kind of were flying by the seat of the pants, or you'll avoid some sort of audit catastrophe in the future because at least all your ducks are in a row and you have proof of everything going on in your business. So thank you once again for joining Thursday night mini masterclass. We will see you in 2 weeks at the end of the month, and happy Valentine's Day, happy Galentine's Day, happy weekending ahead, and let us know if you have any questions we can answer. Thank you.